Hello again. In this video, we will focus our attention on candlesticks. When you first look at a price chart for an asset, you will generally see a line chart that looks something like the one that I currently have on the screen. Although this is a good way to quickly see how price changed over time, this style of chart has many weaknesses and is not ideal for use when performing technical analysis. Namely, this chart derives each of the plotted points only from the closing price of each session for whichever time interval you are currently using to display the chart. So if you are looking at the 1-day interval, each of the plotted points use the closing price for that given day. Same thing goes for other time intervals that you are using. For example, if you are using the 15-minute time interval, each of the plotted points use the close price of each of those 15-minute sessions. However, when performing technical analysis, having more data from each session for the respective time frame that you are looking at will only certainly help. More specifically, the additional information we would like to be able to see from each of the sessions include not only just the closing price, but also the open price for that session along with the highs and lows of that session. Fortunately, candlestick charts allow us to see all four of these aspects for any time interval that we are looking at. When you change the type of chart to a candlestick chart, it will look similarly to the one that is shown here. As you will see as we progress through this course, candlestick charts provide far more information and accuracy in your very own analysis. First off, each candlestick represents a single session or interval of time. As you change the interval of time, as you can do up here, the candlesticks will reflect the time interval that you have selected, and each candlestick will be a representation of the information provided from that session. For example, if you look to use the 5-minute interval, each candlestick will now represent 5 minutes of time. Likewise, if a trader looks to use the 1-week interval, each candlestick will represent 1 week of time and will reflect the data provided from each 1-week trading session. So let's go ahead and break down the anatomy of a candlestick. There are 4 pieces of information that make up a single candlestick. As aforementioned, a candlestick shows the open price, close price, highest price achieved during the session, and the lowest price achieved during the session. Where those pieces of information fall in the candlestick depend directly on if the candle is green or if it is red. A green candle represents that price increased over that specific session, and a red candle represents that price decreased over that specific session. Each candle has a rectangular body, referred to as the real body of the candle, that represents the opening and closing price for that particular session. They also include wicks that extend out from the top and bottom of the candlestick body. For green candlesticks, the price of that session opened at the bottom of the rectangular body, and the price of that session closed at the top of the rectangular body. For red candlesticks, the price of that session opened at the top of the rectangular body, and the price of that session closed at the bottom of the rectangular body. For both red and green candlesticks, the wick extending out of the top of the body represents the highest price achieved during the session, and the wick extending out of the bottom of the body represents the lowest price achieved during the session. These aspects of a candlestick allow traders to see whether buyers or sellers were in control for that respective session, or if the market was indecisive, which we will get into in later videos. Let's go ahead and look at some examples of reading candlesticks on this chart here. So here we are on the weekly time interval, which means that each of these candlesticks represents 1 week of time. Of course, the red candlesticks represent that over that week, we see a decrease in price. Likewise, the green candlesticks represent that over that week, we saw an increase in price. So if we were looking at how to read the values on each of these candlesticks, we could do that like so. This red candlestick right here opened at the top of the rectangular candlestick body at around a price of 43.08. It then went to a high of around 43.26, went to a low of around 41.38, and closed at a price at around 41.92. The next candlestick, this green one right here, opened at the bottom of the candlestick body at around 42.06. It went to a low at the bottom of the candlestick wick at 41.29, went to a high at the top of the candlestick wick at around 44.65, and closed price for that week at 44.53. As you can see, if we change time frames to say the 30-minute candlesticks, We can see that now each of these candlesticks represent 30 minutes of time. And if we say look at these two candlesticks right here, we have a small green candlestick that opened at the bottom of the candlestick body at around a price of 42.34, went to a low at the bottom of the candlestick wick at 42.30, went to a high at the top of the candlestick wick at around 42.41, and closed the price at the top of the candlestick body at 42.35. The next red candlestick opened at the top of the candlestick body at 42.35, went to a high of around 42.37, represented by the top wick, went to a low, represented by the bottom wick, at around 42.28, and closed at the bottom of the candlestick body at around a price of 42.30. As you progress further through the course, you will notice that we will be using strictly candlestick charts for performing technical analysis. All right, so before we conclude, I just want to go over the other different types of candlestick charts that you can use. Namely, we'll be showcasing the hollow candles and as well as the Heiken Ashi candles. So let's start off with the hollow candles. You can go ahead and select them here, and you will get a bit of a different type of chart. But let's go over how to read these different candlesticks. Let's zoom in on a section over here and go over them. So you have hollowed versus filled candles as the first thing. And the main difference between these ones and normal candles is that they include fill attributes to show price behavior rather than just adding the color attributes of red and green. So if you have a hollow candle, that means that price increased from the open. So what that means is, being that we're on the daily chart, each of these candlesticks represents 1 day of time. So if you're seeing a hollow candle, that means that price increased from the start of the day. So it opened down here and it closed up at the top right here. And of course, you can see those values up here with the OHLC. So this candlestick opened at 4423 and closed at 4504 at the top of the candlestick body. Same thing goes for a red candle like this. If it's red and it's hollow, that means that price still increased from the open. So this candle right here would open at around a price of 4308 and close at the top of the candlestick body at 4341. Now, if it's filled, like one of these two candles, that means that price decreased from the open. So what that means is the price opened at the top of the candlestick body and closed at the bottom of the candlestick body if it is a filled candle. So this candlestick right here opened at the top of the candlestick body at around a price of 4545 and closed down here at the bottom of the candlestick body at around 4469. Same thing goes for this candlestick right here. Even though it's green, it is filled, which means that price decreased from the open. So this candlestick opened at the top of the candlestick body at around a price of 4518 and closed at the bottom of the candlestick body at 4492. So with that being said, we do have green and red candlesticks. Now, if the candlestick is green, that means that the price closed higher than the previous session's closed. So if we're looking at a candle like this one right here, this hollow candlestick, it is green and hollow. So that means that price not only closed higher than it opened, but it also closed higher than the previous close. So the previous candlestick closed right here at the bottom of this candlestick's body at 4345. And then this candlestick here closed at the top of the candlestick body at 4348. So that's why this candlestick right here is actually green, is because the close, even though it closed higher than it opened, it still closed higher than the previous day close. And for red candlesticks, it's just the opposite, meaning that price closed lower than the previous close. So if we look at this green candlestick right here, it's hollow, so it closed at the top of the candlestick body at around 4389. And this red candlestick closed at 4349. So it did close lower than this candlestick actually closed at right here. Same thing for the red hollow candlesticks. That just means that even though that price increased from where it opened at, it still closed lower than what it previously closed at on the day before. So this candlestick right here, it closed at 4349. And this red hollow candlestick, it opened at the bottom of the candlestick body at 4308 and closed at 4341, which is still lower than the previous day's close, which is why it is red. Pretty much what the main purpose of this is to allow traders to assign different strengths to a different candle. So instead of just having red and green candlesticks based on the closing price, you have a hollow green, like one of these ones right here, and that's basically showing you that we have full bullish candles. And then you have the filled green, which is indecisive but slightly bullish. And then you have the hollow red, like this one right here. It's indecisive but slightly bearish. And then you have the filled reds, like these ones right here, that are fully bearish. Now, these can kind of be seen as reversal candles. Whenever you get a hollow red or a filled green, generally you can look for a reversal of some sort to start setting up there. They are not, of course, going to be perfect indications of this, but they are pretty strong at identifying reversals. So like we have hollow red right here, reversal to the upside, filled green right here, reversal to the downside. Same thing if you look over here, we have a filled green, that's a reversal to the downside. And if we look at something like this over here, we have that hollow red reversal back to the upside. So these are not going to be perfect indications. They just allow a trader to understand and assign different strengths to different candles. And it just adds a little bit of extra technicals for when you are trading. Typically, in the rest of this course, we will be using the standard candlesticks, but the hollow candlesticks are very useful. And compared to the standard candlesticks, they do add just an extra bit of information. It might be a bit confusing at first, but they are incredibly useful in the long term. And it's just kind of figuring out how you use them yourself. Because remember, all traders have different strategies, and it really just comes down to what works for you. But let's also go over the Heiken Ashi candles. So if I go ahead and click on this, and let's just go to a section over here, you'll see that we actually do get a longer streak of greens and a longer streak of reds. And basically what the Heiken Ashi candles do is that they reduce noise greatly and increase the smoothness of the chart. Look how smooth this chart is compared to, say, if I go to the normal candlesticks where there is a lot more noise over here. It's a bit harder to understand momentum with these candlesticks, but an advantage to the Heiken Ashi candlesticks is that they will tend to give you a better understanding of a trend and momentum. But let's go ahead and talk about how to read them. So you have green candlesticks and you have red candlesticks. Basically, how the points are derived from are by using the average price of sessions as opposed to the true open and close price of a session in order to create that smoother appearance. Now, keep in mind, these ones do not show the exact open and close price, so that is very important to understand, but they do allow you to better identify trends to confirm or clarify a current trend. So let's talk about this. For candlesticks in general on the Heiken Ashi, they open at the midpoint of the previous candlestick. Notice that the bottom of these green candlesticks is where we're actually seeing the open at. And that's just showing that we're opening at the center of the body of the other candlestick that was prior. So notice these ones are all opening at the midpoint of the previous candlestick's body. Where these candlesticks close is they take the average of the session open, high, low, and close. So they take the average of all those, and then they go ahead and plot that as the closing price, which is why the open and close are not true open and closing prices, but rather they're averages to help you better understand the trend. The highs and lows are still represented by the wicks. However, if we're looking at a green candlestick and there is no low at the bottom, that just means that the session did not reach lower than the midpoint of the previous candle. So that means that the low of all these did not make a low that was lower than the midpoint of the previous candlestick, aka the open price. So for red candlesticks, we have been talking about green candlesticks a lot, but let's talk about the red ones real quick. The red ones are the same thing, just flipped, meaning they open at the midpoint of the previous candlestick, and their close price is just the average of the open, close, high, and low. And of course, if a high is not made higher than the midpoint of the previous candlestick, then you won't see a top wick. And of course, we talked about some advantages of this being the smoothness and reduction of noise. And there are going to be longer stretches of green candlesticks and red candlesticks. But where this really comes into play is when you're seeing a long stretch of candlesticks that are the same color, and you're seeing no wicks that are extending out of the bottom. And basically what that is telling you is that if you're not seeing any wicks coming out of the bottom of the candlesticks, that means that the trend is actually still in full effect, and you don't really see the trend start weakening until you start getting those candlesticks showing wicks out the bottom, meaning that we're seeing lows lower than the midpoint of the previous candlestick. Once you start seeing that occur, that shows that there's weakness occurring in the trend, and we're likely to see a reversal of some sort. Notice we're seeing that over here. We're seeing those candlesticks create lows lower than the midpoint of the previous candlestick, and then we get a reversal to the downside. Same thing over here. We start getting those highs that are higher than the midpoint of the previous candlestick, reversal to the upside, and this is just adds as another confirmation to go ahead and understand identified trends in general. So the great thing about these is that they can still be used to identify consolidation periods. Like say if I go ahead and just draw some trend lines right here, we can still identify consolidation patterns. Like this would be, of course, a falling wedge pattern, and they still do maintain the shape here. However, what the drawback of these candlesticks are is that they lack the ability to identify the candlestick patterns that normal candlesticks show. So if you're looking for, say, like a bullish engulfing candle, it's not going to show so much on the Heiken Ashi candles as they would on the regular candles, but these ones are more so for confirming and identifying trends. And guys, remember, one type of candlestick chart is not necessarily better than the others, but they each have their own advantages that make them very useful in certain situations. And I'd recommend trying them all out and seeing which one works for you. Anyway, that'll do it for this video. In the next video, we will be talking about support and resistance levels.